Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for September 18th, 2022. I want to say thank you very much for spending your time with us. I got a really big show for you today. We got a lot to talk about. It's going to be a huge week this next week. Some major levels have been breached. Some major levels I'm questioning in certain markets. And so we're going to cover all of that and more here in just a few minutes. But I want to say, first of all, if you like this content, you like the week ahead videos, you like this free content that you get every Sunday, give us a thumbs up. Subscribe to the channel so you don't miss any of the content if you haven't done so already, because it's free to do that. It's free to give us a thumbs up too. And I know our team appreciates it. Also, if you see us on social media, please share this video. We'd appreciate that. And I do have to make an announcement. So stand by for just a moment while I say this. We have not raised our prices at Forex Analytics for 4 years. In our 6 years of offering the Forex Analytics platform and the community to traders all around the globe. We will be raising our prices substantially at the end of the month, or towards the end of the month. We haven't set on an exact date, but we're talking probably in about a week and a half. So, and that's from, we're talking mid September 2022. So our prices are going to go from $119 to $189 a month. So if you want to lock in your prices now, this is the time to do it. We have people that are grandfathered in from 6 years ago that are paying substantially cheaper amounts than you see right here, but we will be raising our prices. We have to. Prices are going up everywhere. From our Amazon cloud servers to our developers and what it costs for our team. So I'm going to tell you right now, lock in your prices, because these are going to be the best prices you're going to get. So make sure you do so here in the next week. And right now, like I said, $119, and you get $1 just to test it out for 10 days and see if it's right for you. So make sure you do that today to get your 10-day trial. All right, now let's move along and let's get into the markets, because that's what we're all here to talk about. Next week's going to be a big week. I'm not going to go through all the charts here on the Forex Analytics platform. The reason why is because they're being updated and analysis is being uploaded throughout the weekend on basic technical analysis, harmonic, Elliott wave. Different instruments will be updated. So instead of going through these charts and trying to draw on this screen, I'm actually going to just take us to just a chart we can draw on. But let's talk about this next week and why it's so important. So we had the CPI data come out, and the dollar rallied substantially. It did rally substantially. We didn't hit new highs, and it kind of set the tone going into this week, knowing that the Fed, which will be meeting on Wednesday, the 21st, which is going to be, I think there's two parts to this week, by the way. So on Wednesday, September 21st, we're going to have the Fed, who's going to have their meeting. Now, I want you guys to think about this for a second. Nick tomorrow from the Wall Street Journal, he's kind of known as the Fed whisperer, right? And he had an article, I guess, last week that said, hey, could be basically, just cutting the chase. We could be setting up for a full percentage rate hike by the Fed. Now, I'm going to just tell you this. I'm not in that camp. I don't think the Fed's going to go a full percentage point. But sometimes the Federal Reserve will reach out to people like Nick, in this case, put that out there. So everybody's like, oh, crap, here the Fed might raise rates by a full percentage point. And then they'll come in below it. And what does the market do? The market relief rallies, right? So that's kind of like my anticipation going in. No, that doesn't mean it's going to happen. What I think happens and what does happen are two totally different things. It's not always reality, right? And that's us as traders. We try to anticipate what we think is going to happen. And sometimes we have to react to what actually happens. And that's kind of what this week is all about. So when you look at the dollar index, the dollar index really is struggling up here at these highs. Remember, we had false breaks of the resistance on this channel, false breaks below the lows. You might say, well, maybe that channel is just not in existence anymore. You could argue that, but what I will argue is that we are up against 20-year highs right now. So if you want to go ahead and fade it right at this moment in time without knowing anything else, I get it, because your risk is right here. But I'm not going to tell you that we can't rally to 112.70 right now, which would be a 161% extension of this move. Now, these are charts that I use throughout the course of the week, but I'm going to be going to some of the charts that I've been using here specifically for the week ahead video. Excuse me. So, as far as the dollar goes, I think we have to be a little careful with the dollar because we might get a relief rally in equities if the Fed only delivers three quarter percent rate hike versus a full percentage point. Now here's another chart, and I'm gonna pull this out here. This is Chris Weston, my colleague over at the trade-off from Pepperstone. He brought this chart showing the terminal rate, and you can see on Friday it started to come down a little bit, and that's what the market expects the Fed to reach all the way to. Now, remember, the Fed's at 2.5%. So this is the market telling us that the market's expecting the Fed to reach all the way out to 4.5% at its high point. Now it's starting to come off again. I would be watching this chart because if the terminal rate starts to fall, that means that the market is anticipating the Fed is just not going to be as aggressive. They might rate, like let's say they raise rates 0.75%, and then everybody's like, oh, they're going to raise, maybe a 75 and a 75, and that gets us to 4.25. So that means the terminal rate would actually fall down to this level right about here. And if let's say it ends up being a dovish hike, now I don't think that's going to be the case, but let's just, for argument's sake, let's say it is, the Fed might deliver a 0.75%, or let's say maybe even a full percent hike, but maybe it's dovish. Maybe the rhetoric is dovish. They're like, well, we're going to front load this and then we're going to see what happens. Well, then maybe the terminal rate might actually even come down further because people would say, well, maybe the Fed actually just raised rates by 100 basis points or a full percentage point. And then now we might only get 50 and 50, and that would bring down the terminal rate to 4%, right? So the terminal rate is what the market is expecting the Fed to eventually reach to. If that comes down, that means the dollar is going to come down. More than likely. And that's why I'll be watching this chart during and after the Fed meeting. So let's go ahead and I'm going to take us off that really quick, and let's go over to the dollar itself, back to the dollar index, because I do want to continue this conversation regarding what the Fed may or may not do. So it's not easily, it's not cut and dry. Oh, they're going to raise 0.75% or 75 basis points, and that's it. No, we've got to listen to the Fed chair, his words, see how adamant he is about, inflation. If expectations are going to be really coming down from here, rents may have peaked, crude prices are coming down. So gasoline prices are coming down. The price of the pump is easier on the consumer globally, especially here in the US. Rents are coming down. Prices might start coming down. And if the Fed starts to cue us in on that, then that means that would be a dovish hike, and we might see the dollar roll over. Now here, you might ask, well, Blake, what are you asking? And I said earlier, the market has two parts. I'm sorry, if you live in certain parts of the country, this would be similar to me flipping you off, and that's not what I wanted to do. So you're in the UK, you're like, hey, don't say, what are you doing? I'm just kidding. What? This week's going to be in two. All right, I'm going to try to be serious now. This week's going to be in two parts. First part is going to be the first half of the week ahead of Wednesday. So why is that such a big deal ahead of Wednesday? Well, we have gold. Let's talk about what's happening with gold. So the gold market is actually breaking lower. Massive support, but we closed right at previous support, which now is current resistance. I'm going to be watching gold really carefully. Now, I am going to tell you guys, I do not believe this fall in gold. Why? Because I thought we would reach a little bit further before bouncing. I thought we would reach for 1650, maybe even as far as 1600 and bounce. I thought it'd be a big flush and out. But what happened is interesting. I think the market is sentiment is very poor here because it's so extremely bearish that the risk is that we bounce. Okay. That means we bounce higher. Now, if gold bounces, one of the best relationships you're going to find in the market is the gold dollar relationship. So let me pull up the dollar index. Okay. This is, I know it kind of bucks the trend every once in a while. Excuse me. But for the most part, historically speaking, when the dollar goes up, gold goes down, vice versa. Okay. There will be periods where they do move somewhat together. A lot of times that's during periods of risk aversion, maybe times that, rates aren't really moving. But for the most part, generally speaking, gold goes up, dollar goes down. Great relationship, something I always pay attention to all the time. So let me go ahead and get rid of that. And the reason why I say that we've got to be watching gold here is because if gold does bounce back above 1700, that's going to signal to us there is a false breakdown. Now, my goal as a trader is try to prepare or position myself ahead of a key event. So what is a key event? Well, a key event is going to be, you named it, on Wednesday, right? You have the FOMC. So let's go back to my original analysis here about the Fed prepping the market for a full percentage point hike and only delivering 3/4. So the dollar index is already elevated. In the event that the Fed delivers only 75 basis points, the dollar might actually sell off after that. Now, if it sells off, what I'll be looking for is to see if gold actually rallies. Now, if gold rallies, the actually trade that I'm already in, just so you all know, I'm already in, but I'm looking to add is short dollar yen. Okay. Most of you know that I picked off the dollar yen at 145 or close to 145 last week, or is it last week or a week and a half ago? It's actually at 144.30, I think is where my entry point was. Traded on the short side, made a good, probably one of my better trades of the year right off of that resistance. I did it again when it rallied earlier this week. And now I'm short going into this next week. Now, what I need to happen, and let me just clarify, what I need to happen and what does happen are two totally different things. Okay? Two totally different things. I hope gold actually reverses and goes higher. That means that the dollar yen will probably break down. Now, with the BOJ, the MOF, you got finance ministers like Suzuki. He's, they're all sorts of checking rates, making comments, giving us the verbal rhetoric intervention without intervening yet. That is now a risk to anybody who's short yen or bullish dollar yen. And I'm trying to lean into that. So if gold reverses, the dollar yen will actually start to show some weakness. And then if the Fed delivers us a dovish hike, that means 75 basis points higher, but then signals to the market, hey, look, we are now starting to get concerned with it. We think that inflation is going to start to come down. They bring down inflation expectations. Then the dollar yen will come down aggressively and probably break below 140. Okay. Now, before I continue on with some of the other currency pairs that I want to talk about, which would be the Swissy and also the sterling regarding the Bank of England and their rate decision this week, let me bring you to our webinar or our show sponsor, and that is going to be, if you haven't seen it, is going to be the Trader Funding Program. So if you want to learn how to trade our money and not risk any of your own money, check out the Trader Funding Program, because you can take 75% of the profits and you don't take any of the risk. You do have to pass an assessment. The assessment does that's where your cost is, and your only risk is the assessment. You have to prove to us that you can actually trade in a demo environment and make 10%, not risk more than 5%, and you have a trail that manages throughout the account. So if you can do that and you can pass the assessment, you can actually trade a larger trading account. This is great for people that don't want to risk their money, their own money. They'd rather risk somebody else's like ours. This is great for people that don't have access to larger capital amounts, and they want to, access larger amounts so they can trade on and leverage up with a bigger size. If you want to know more about the Trader Funding Program, scroll to the very bottom. There's a video with me. It's a 2-minute video. It'll explain it to you. It's called the Trader Funding Program. So just go to traderfundingprogram.com. Now, there's a couple other key components to this that is really critical. One, we don't put a time limit on you passing your assessment. Most prop firms, they'll put a time limit, but we don't. Why? Because we want you to trade at your own pace. We don't want you to be forced into making trades. Also, that we give you Forex analytics for a certain period of time, so you're not on your own. You can actually jump in our community. You can jump in our chat rooms right here, right over here. Let me bring one down. You can jump in our chat rooms and talk about the markets and talk with other traders about what's happening, knowing what trades other people are taking, and you can actually get news and research, and you can talk about the macro movers of the market in the Flowonomics room. It is a really most valuable resource to you as a trader that's going through the Trader Funding Program is having support. And we give you the support from our community, where many traders go, and to have that community of people around, to take advantage of. So with that being said, let's go ahead and continue on. And let me just go ahead and get back into the charts. But remember, traderfundingprogram.com. Check it out. All right, let's get back into the markets. Let's talk about the Swiss National Bank. Now, I've played the Swissy a couple of different times off of this support. Down here at 95 cents, 94.80. I've bought it down here a couple of different times. I'm getting a little nervous about buying the dollar Swiss. The reason why, and if you haven't, Swiss National Bank is coming out of negative rates. I believe they've been in negative rates more than a decade. Somebody's got to help me out with that one. You can jump in the comments down below and give me, and you have Google, you can Google it right now. I'm not going to do this because I'm obviously talking to you right now, but the Swiss National Bank is going to be raising rates, and the market is expecting them to raise them by 75 basis points from negative 25 BPS to 50 positive BPS. So that's 75 basis points. As the Swiss National Bank comes out of negative rate territory, that might spur some movement in buying Swiss, especially in a risk-off environment, which I will talk about stocks at the very end, so just bear with me. But that's something that, in my opinion, if we break back below, and let me just go ahead and show you guys something. If you take this low back in August 11th, take this high, and let's go ahead and put it on a different fib so you can see it. The 78% retracement comes in at 94.80. That 94.80 level has held. But what that also means to me is if it breaks, we should go from 94.80 somewhere down here. And I'm going to give you a variable. It's going to be down here, down here, down here. It's not depends. Everything depends on something, right? So in this case, it would be depending on if the dollar is falling. Also, if there's risk aversion, because if there is risk aversion, the Swiss franc could become the market's, currency of choice to own in a risk-off environment other than just the dollar. So if they're like, okay, I have way too much dollars, I need to start buying something else. I'm going to take the safety of owning some Swiss francs. I'll buy the Swiss franc. Now, if you just kind of do a little bit of just very basic technical analysis here, and you just grab this and just see where we might be able to go. This might be more realistic, but just think about that because, a move from 94.80 down to 92.80, that's 200 pips. It's a nice return, right, on a breakdown. So just keep that one in mind because the Swiss National Bank does meet Thursday morning after the Fed. Last but not least, the Bank of England. Now, you guys know I've been bearish the sterling, looking for channel support. This was 160. Here, let me just show you this chart. We talked about it all week on our free face shows and the flow show. If you don't know where to find our free shows that we do throughout the week, you can click on the links in the descriptions down below in the description of this video, or you can go to where we're on forexanalytics.com, go to webinars. We have the flow show, the face show. Make sure you're tuning in. I mean, because you're going to hear me and the rest of the team and talk about what we're expecting in the markets. Well, with the sterling, most of you knew that we hit 161% extension right here at 114. So being short down here at channel support at 161% extension is not my cup of tea. This is not, being short down here is not what I'm going to be doing. I already shorted the sterling. I'm done being short. Now, most of you will sit at home and you'll ask, well, Blake, if you're not going to be short, that means you must be bullish. That's not always the case. Just because I don't want to be short doesn't automatically make me bullish. It makes me neutral. What's going to make me bullish? Well, we get a false breakdown and we get a Bank of England that sounds like, holy cow, they've got to really intently fight inflation going into this fall, knowing that energy costs are going to rise so quick that inflation rates are going to jump, make it very uncomfortable for the UK consumer. Well, if I get that tone after Thursday morning, will I be buying the cable down here, or maybe even a little bit higher, chasing it a little higher, maybe above 115? Yeah, that would be a trade that I'd be interested in. But I kind of have to wait for the Bank of England on Thursday. Now, last but not least, I told you I would go into the equity markets. Let's just talk about the S&P and where we're at right now. The S&P broke a really, really critical support. We came out of an ascending wedge. You guys all know that. We bounced off the 618. The problem is that you see here in the S&P, first of all, we have a descending channel. The second problem with the S&P is that we broke through the 618 retracement. The third problem, and if you guys don't read the Forex Analytics blog, you already know this because it's free and I put it out there for everybody to know. We had a false breakout above that channel resistance. This was also, just so you know, that was a 618 retracement. Actually, by the time we spiked in the futures market, it was a 618 retracement failure up there, and now we're rolling over again. So the question is, how far can we go here in the S&P? Well, my opinion is we could very easily see new trend lows, but we're going to have some major support coming in, around the 3,600, obviously 3,400 breakout point. Should we get down that low? But if you went out this week in the weekend, bullish stocks, you have to be really careful that we closed in breakdown territory. Now, what could turn the market higher? Go back to our conversation a little bit earlier. If the Fed delivers the market a hike, but it's a dovish hike, that could eventually create a false breakdown and take us higher going into the next few weeks. But that, to me, is going to have to be proved by the Fed, which will be on Wednesday. And also we'd probably have to see my opinion would be you have to see a move, solidly back above 3,900, maybe 4,000 in the S&P, this 200-day moving average, for me to get, that's not a 200-day moving average. There's your 200-day moving average. The S&P would have to get above 3,900 and really probably back above 4,000, above these levels before I start saying, okay, look, we might have a 200-300 point rally back up towards the channel high. But I need proof, okay? I need proof. There's a lot of other things that are happening this next weekend. We have producer prices in the Eurozone on Friday. We have Canadian inflation data on Tuesday. If you guys want a view of the Canadian U.S. dollar Canadian, and I'll just give you a quick view, but it's nice little bullish breakout. However, that inflation data comes out on Tuesday. I think you have also retail sales out of Canada, which will be on Friday. And if you want more analysis on the dollar Canadian, guarantee you come in on Monday or Tuesday to the free face show. You're going to get analysis not only from me, but the rest of the team talking about the Canadian, and we'll be covering that CPI data live on Tuesday. So with that being said, I want to say thank you so much for spending your time with me. I know it's very valuable to you. It's very valuable to me that you do spend your time with me. So I want to thank you for that. My name is Blake Morrow. I'll see you on Monday morning on the Face Show. Have a great remainder of your weekend. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.